Hey, welcome back to the channel everybody. This is Nick. In this video, I'll be discussing multi-time frame analysis. Now, what exactly is multi-time frame analysis? This deals with jumping from the higher time frames, like the monthly, the weekly, the daily, and dropping down all the way to the lower time frames, whether that be the 4-hour, 1 hour, 30-minute, 15-minute, 5-minute, and acquiring information from each and every time frame on the charts to lead up to your entry point where you want to be entering in the market. So we are combining all different time frames from the higher to the lower perspective to gain a bias on whether we're going to be buying or selling. With that being said, what is the overall significance of multi-time frame analysis? Well, when you're combining the higher time frames, which you're going to be getting the overall direction of the market, with the refinement that comes with the lower time frames, this brings a massive amount of clarity into your trading ideas. It's very simple as well. All you have to do is go from the monthly to the weekly to the daily, and you're just dropping down by the time frame, which is a very simplistic and easy way to perform analysis. All the noise and all the banter of overcomplicating trading doesn't have to be made when you perform multi-time frame analysis. And on top of that, the accuracy of your trades and the win percentage has a very high chance of increasing, since you are putting a lot of different pieces of information together instead of just trading emotionally and just winging it. You're doing things in a very step-by-step manner, and this is a great process to base your trading strategy off of as well. Let's see what multi-time frame looks like on the charts. Starting out on the charts, I am initiating my analysis on the weekly time frame on a base level. Let's read the market real quick. We have our downtrend here with a break of structure right above here, insinuating a uptrend. And on this portion right here, once this was broken, this is our most recent higher low point. Once that was broken, that insinuated a expansion to the downside with a downtrend, pull back on a weekly uptrend, expansion to the downside, another pullback. This high failed to break, then insinuating a full-on weekly downtrend. Another pullback, downtrend, and now we're on another pullback here. So on a weekly perspective, where price is currently at is a pullback on this weekly downtrend, now forming a small daily uptrend as we break down to the daily time frame. So to gain my overall directional bias, I'm working on the higher time frames. I would consider the monthly, weekly, daily, and some added time frames like the 12-hour and the 8-hour I put on here to be higher time frames. Now on the daily time frame, what I normally like to do is do most of my markups in the vicinity of where price is currently at. So what I normally do is I'll take a horizontal line and mark the high and low of the most recent daily candle right here. So we have our high and low of this specific daily candle here. So what's going on here? We had a daily downtrend from July 1st all the way up until August 26th. And if we pinpoint market structure, we have our high, lower high, lower high, lower high, and lower high point. Now, what happened here was a break of market structure right above here. Once this point was broken, this now seems to be insinuating a change of direction in market structure. So now we could be potentially moving upwards in the long game, characterized by our low, our higher low point, our higher low point, another higher low point, and what seems to be another higher low point. So right now on the daily time frame, I'm going to possibly be looking for specific buy positions if the lower time frames agree with me. Now jumping down to the 4-hour time frame, what I'll then do is mark up my key points of reversal, my key market zones in relation to where price is currently at. So now on the 4-hour time frame, I'm going to be creating my key market zones. This will be areas of reversal in the market just to gain a good depiction on where price could potentially be reversing at. So we have our first market zone here, and I'm looking for key areas of the market where the market could potentially reverse off of. And at the end of the day, I'm going to be placing my trades and formulating them around these key market zones. So this is something that you don't really want to be lackadaisical with. You want to have the utmost precision with these. Here's another market zone right here. And I want to essentially trap price. So let's say price breaks above this market zone. Where's another target we could be potentially going to? All you have to do is look left and look for key areas of reversal. Here was a key area of reversal here and right here. And the more touches, the better. That is my rule of thumb with market zones, and all I'm going to do is drag them across here to where price is currently at. Might even jump right back up to the higher time frame, the 8-hour, to gain an even bigger perspective. And I'm just looking once again at key areas of reversal now. So we had a wick here, and you can use the wicks of the candlesticks as guiding points as well. I'm just going to drag that across. In the event that price continues to push up, we have areas to trade against. Now going back to the 4-hour time frame, I can see now a clear uptrend on this time frame, characterized by our low points, higher low, and a new higher low point. Push up, pull back, expansion, pull back, expansion, pull back, another expansion, pull back, and what seems to be another expansion right here. Now let's jump down to the 1-hour time frame to solidify key market zones, clean up the charts when it's necessary as well, because it's all about gaining clarity. So now while we're on the 1-hour time frame, what I'm going to be potentially looking for is another pullback here. So what I usually do is take the Fibonacci retracement tool, go from the high all the way down to the low point. And this would be considered a counter trend trade. We could be looking for price to be coming into this specific Fibonacci retracement region between the 61.8 and the 78.6, maybe retest the new low and expand out. So this is how I would specifically formulate my trade on the 1-hour time frame. Take the short tool, potentially go from here, take the Fibonacci just above the 78.6, pull it down to the low. We have our key market zones lined up here. We can actually take out a demand zone on the 1-hour time frame right here, and I'll recolor this just to distinguish it from my other zones in the market. And we're just going to be waiting for price to potentially pull into here and expand down. So now that price has pulled into here, our trade is initiated as we hit a demand zone. On the 1-hour time frame, we have a current downtrend characterized by our high, a new lower high, a new lower high, and this lower high was not broken, so that initiates that this downtrend on the 1-hour time frame is still in effect. Now as price reverses down, we are currently now from our entry point a good solid 84 pips in profit. Price continues, hits our key market zone, and retests that. As the market pulls back, what initiated that pullback was a retest of this specific 200 EMA, giving us that exit confirmation to completely exit the trade. That will give this trade exactly 132 pips in profit, completely acquired, just by formulating the monthly perspective down to the weekly, down to the 8-hour, 4-hour, and 1-hour time frame. In this specific example, we didn't even have to use the lower time frames like the 30-minute, 15-minute, and 5-minute. But if we go down to the 15-minute time frame, the lower time frames, we'll see here you could actually refine this demand zone right up top here. and you get a pinpointed supply zone to sell off of. That is layered on top of the 70.5% Fibonacci level. Also, further confirmation of this specific lower high point not being broken through, abiding by the rules of market structure, and using that 2-hour advantage as well. Bringing it back to the 30-minute time frame, we have some equal lows here, and resting right below that is something called liquidity, which is all pending orders right below a key pattern in the market. So there's stop losses, buy stops, sell stops, all resting below this. And we also had this gap right here from the market open as well. So the market traded below that liquidity, filled the gap from Sunday night at 5 p.m. Eastern Standard Time when this was filled, and then the trade was finished. So even though we had our 156 pip profit target, we had also a gap here, liquidity below this, showing us that this trade needed to be exited at an optimal time. So folks, that's how it's specifically done when you match multi-time frame analysis and confluence trading, when we take all of our confirmations and build them into one specific area in the market like this. If you received any sort of value from this video, be sure to hit the subscribe button, like the video, post a comment with any questions, comments, possible concerns with the systematic approach here, and stay tuned for future videos.